it will be all right. All right. Everything seems to work properly. So that's good. That's good to know. Very good. And we'll wait for a minute or two until a few more people join, and then we can start. I have a lot of interesting topics that I think deserve a bit of attention. Hopefully, we can chat a bit, connect with each other, and well, have some fun. Let's see. All right. Well, the first interesting interview of this year is definitely the one of Zuckerberg on Joe Rogan. I have not seen it. I have not listened to it yet. I'll probably save it for Monday when I'm in my car, so it will be a long ride. And it sounds like the right time for that. But I stumbled upon this video that I'll play now. That's basically Mark Zuckerberg criticizing Apple for not inventing anything great in a while. So I'll start this for a bit, and then I'll share my thoughts on it, of course.
They haven't really invented anything great in a while. It's like Steve Jobs invented the iPhone, and now they're just kind of sitting on it 20 years later. And they actually, I think year over year, I'm not even sure they're selling more iPhones at this point. I think like the sales might actually be declining. I think part of it is that each generation it doesn't actually get that much better, so people are just taking longer to upgrade than they would before. So the number of sales, I think, has generally been flat to declining. So how are they making more money as a company? Well, they do it by basically like squeezing people, and like you're saying, like having this 30% tax on developers, by getting you to buy more peripherals and things that plug into it. They build stuff like AirPods, which are cool, but they've just thoroughly hamstrung the ability for anyone else to build something that can connect to the iPhone in the same way.
So there are a few things that I agree with him on. Like, first of all, yes, they are squeezing a lot of money out of developers because they have this 30% fee. On the other side, one can argue that they deserve a large portion of that because they have built this ecosystem. And when it comes to innovation, it is true that not much has happened when it comes to the iPhone. All the subsequent upgrades have been nothing too significant. But on the other side, the main reason is that they have a really good product. And yes, they have some peripherals like the AirPods, and they have Apple Watch, they have MacBook, other products. So I don't fully agree with him. There has not been a lot of innovation. But what I find unfair is that Mark Zuckerberg gets to criticize a company for not being innovative, while, well, what has Meta done? Obviously, there's Facebook, but all the features that are, or the new features, have been copied from other platforms like Snapchat, like the stories. He acquired Instagram, which is definitely not innovation. There's Threads, that's just a copy of Twitter. So I also don't think that he's the right one to criticize for not innovating well while he's sitting he's in charge of a company that's quite significant in size that has not done much when it comes to innovation. I mean, probably anybody from Apple can do the same, can say the same about him. He's just squeezing more money from the users by just pushing more advertising. So I do agree that of course Apple, obviously, if it was Steve Jobs, then probably there would have been more innovation, maybe more crazy ideas. But I don't think that Mark is the person that should be behind this criticism. Yeah, the metaverse, that's definitely a good one. I mean, it's in progress, right? But there's nothing substantial there. There's nothing, it doesn't drive significant revenue for the company yet. So again, I find it a bit odd that, but anyway, I'll have a listen to the podcast probably on Monday. And but if any of you has listened to it, let me know if it was worth it, or maybe not. Maybe it was just a few hours of time wasted. But now that since we're in the new year, we can have a look at a little bit of the S&P 500. Obviously, it has a rough start. I don't know, 1%. Apparently, some categorize it as a rough start. There was this jobs report that was actually, there were more jobs created than expected, and that is being perceived as negative news. I like the quote of Peter Lynch when he says, if you spend 13 minutes on a year on macroeconomics, you've probably wasted 10 of them. I obviously, he's oftentimes being taken out of context, that he believes macroeconomics is useless, which isn't the case. He just claims that it doesn't deserve as much attention as it gets, and probably that is the case. I mean, if you take a look at the best performing companies, and if you zoom out the last even 5 years, you can't pinpoint when inflation was higher than expected, or where the job reports was better than expected. It's just, these are really short-term events, and they have some impact on the price movements, but not much more than that. But what I find very interesting is every year these big companies come up with their S&P 500 price targets for the next 12 months. So in this case, this is what it looks like for the S&P 500. So it ranges from 6,500 to 7.1. It's quite a gap. And the reason why I want to give attention to this is this happens every year, right? It's not new. It's every year there's the same predictions by more or less the same companies. So if you take a look at what happened last year, everything that is in or these black circles, those are their initial targets. So they had these targets in December 2023 for the end of 2024. If you take a look at the range, they were between 4.2, that's JP Morgan, up to around 5.2. Well, if you take a look where the year ended, it was closer to 5.8 actually. So somewhere in October, almost the end of the year, basically they did an upgrade of their targets. But take a look at the discrepancy of the updated target or the actual S&P 500 year end versus their initial targets. It's quite clear that these professionals that have great analysts, right? That's how it should be phrased, because they have really good analysts, educational wise. But they're off within 12 months. We're not talking about the next 5-10 years. Within 12 months, they're off in their predictions, and of course they're off. It's very simple. This is a proof that predicting the short price or short-term price movement is just not feasible. Even professionals like the biggest banks in financial institutions fail. So this is something to keep in mind when you see the predictions for next year. They're just pointless. They're just guesses. Oftentimes, I mean, probably guessing closer to the 10% is kind of the average historical return. So that's your best chance to be right or not be wrong by as much. But yeah, we had a great year of 2024, and the analysts were significantly wrong. And it just again proves that you should not trust any short-term prediction just because it doesn't work. It just doesn't work. And every year is the same thing. But if you are looking at a company that's had a tough start of the year, I think that's Greg's. I have not looked into the report in detail. I am not familiar with the company as much. Probably those who are in the UK can share a bit more, but it's 24% down on a report that I think the report, even the sales were up year over year. So but yeah, UK in general is not. It's a tough place to be in. It's a tough place to be in. I mean, there are very few companies that have done well over the last decade even. You know what? Let me check the UK FTSE, the index. Take a look at that. If I take a look at the last, yeah, it's since the 2000s, it's up like 27%. So in general, UK has done quite poorly, but I'm surprised because I've heard that this is a quite well-known chain within the UK. If I'm not mistaken, they're only in the UK. I mean, maybe I could even have a quick Wikipedia search for that. Oh. It's British, but I'm not sure if they expanded outside of the UK. I think it's just within the UK. So it's interesting. These are the type of companies that are probably well known domestically, and then if they have loyal customers, then maybe they'll be able to pass the increased costs over time to them or not. But it's definitely an interesting development that you have a company that when the sales are up, and actually as expected versus their guidance, yet the share price is down 24%. I have a list of topics that I'm not sure what I should start with first. Maybe I'll address a topic that I know is being it comes up in a lot of discussions, and that is valuation through the ratios. In the recent maybe years, I'd say I've been looking at a lot of deals for small companies from a due diligence point of view, and I thought it would be fun to share a simple example that would outline the impact of PE ratios in general. And I'll start with one example of a small business, and then I'll move to another one that I think it would be a lot of fun, and I'll use Excel because I know that most people who are in finance or interested in this stuff, well, they'd enjoy it if it's in Excel. So this first example would be, let's assume that there's a company that sells tables, right? So it's a tables reseller. So I'm using even a company that has no manufacturing. It just purchases tables from some supplier and sells them to customers or maybe businesses, whatever. And every year there's an annual demand of 75,000, right? That's the annual demand. So 75,000 tables. That is that is the demand for their products. So let's assume that the average or sales price it's 500, and the cost is 300, right? So I'll use dollars as a. So what happens is they have revenue of 37.5 million. They have costs, and they have, so this is the gross profit, right? So I'm simplifying this just to prove a simple point, right? So these are direct costs, cost of goods sold. Then let's say that they have some operational expenses of 10,000 or 10 million, so in this case 10 million, and they're left with profit before tax of 5. So I'll keep it simple. Now, let's assume that the supplier that brings this 75,000 tables to us, to this particular company, reaches out and says, hey, I know I've been selling to you 75,000 a year at 300, that's the 22.5 million. I have a special offer for you. If you can buy 100,000 instead of the 75, so the new, I would say, or maybe new amount, if you can buy 100,000, so not the 75, if you can handle more inventory, I can give you a new price for you. It's not going to be 350, it will be 250. So instead of the 300, it would be 250. So now what happens is the cost per product goes down. However, you are stuck with excess inventory. Well, if you intend to sell the business, then that inventory left over is none of your business because it's being passed to someone else. But this very thing happens in large companies as well. When they make a bigger order, they have a better price, so their gross profit improves, it looks impressive, their profitability goes up, The problem is that their inventory goes up over time. So what would happen in this case, right? I'll zoom in a bit more. Let's take a look at the same things, right? So this was scenario number 1, as is, and this would be scenario number 2. So the revenue would be 75,000 because that's the demand at the same price. Then the direct costs, they have the 75,000 at 250, right? So their profitability is much better. The operational expenses, they remain the same. And now the profit before tax is much higher. So if you want to sell this business at a multiple, whether it's EBITDA multiple or profitable, obviously this one looks much better, right? It looks much better. The problem is that in this case, you're stuck with inventory. And the inventory is 25,000 units times the 250. So you're stuck with quite a bit of inventory, right? So this is why it's important to at least monitor the inventory over time, because if you're not monitoring that, you might end up looking at a company with impressive profitability, but in reality, it has no cash. It's not generating as much cash, and you're stuck with inventory. And what happens at some point is impairment, right? And it could be because of, once in a while, but then they're going to label that as that is it does become an asset. But the problem is if you have an asset and then the next year you order 100,000 more, then this inventory is doubled. And then if this is probably, it will be a multi-year contract because you're getting a better deal. You just end up stuck with inventory that is on the balance sheet as asset, but if you don't sell it, eventually it becomes obsolete, especially if it's a product that has a certain time before it becomes obsolete. So if it's a table, it might get damaged. There's so many things that could happen to any product. However, in the short run, the profitability is much better, right? There's no doubt about that. So you have a better business. The business looks better from the outside than it actually is. And this is why the inventory is something that should be monitored from a slightly different angle. So when I'm looking at smaller businesses, especially, this is very important. And if anything, this will be presented as a deal, as a much better, because not only that you have a more profitable business, but guess what? You also have a lot of inventory that you can use and sell, right? So it sounds way better than it actually is, because that inventory you're not going to sell. And in fact, you have a deal that's not that is in place that's not very helpful for you, that will only harm you in the long run. But obviously, those who are selling a business, they spend a year or 2 or 3 years sometimes making sure that the business looks as good as it can, so it attracts the attention of the seller, and it basically it's more difficult, at least, to find out what you're missing, what is wrong, what is being hidden. And I'll give you another example that I think is equally important. It's actually even more simple. Let's assume that you have a business that is, let's say you have a chauffeur business. How is chauffeur spelled, by the way? Sure. A chauffeur business, right? So there's a gentleman that has been running a chauffeur business for 30 years, right? So this is not a new business. And he says, look, I'm in my 60s. I'm done with this, and I just want to pass it on to someone else who can take care of it. And so what do you get when you buy a chauffeur business? You get a car, right? That's the asset, and you get the customer relationship. Something that has been built throughout the years, or the current, or the client list. You can call it. You can call it different ways. And the question is, what is a fair multiple? So let's assume that the proposal is you can buy it at 3 times earnings. It sounds quite good, right? I mean, 3 times earnings. Now let's take a look at the P&L. It has a revenue of 100,000. It has no costs because there's no no direct costs. They're not selling a product. And the only cost is depreciation. And they have some operating costs like accounting, tax, and all the other stuff. So let's say other expenses. And let's say that these are 10,000. So if you take a look at this, the first question you might say, well, wait a second, what about the salary, right? So let's assume that this was a car of, it's quite a extraordinary business, so you need to have a good car. So you have a car that's being depreciated over 10 years. So this is what you have. So the profit before tax is quite good. Let's assume that the taxes is, let's say 20%. And then you have net profit in the end. And then the offer is you can get it at 3 times the earnings. So 200,000, you have the business, it's yours. And all you have to do is just take care of it. It's a business, it's up and running. In theory, this sounds quite good, but of course, the first question that you'll have is, well, what about the salary? There's no salary in here. All it has is a depreciation for the car. Eventually, it will need to be replaced. And these expenses that are just, that the business incurs, like accounting and, I don't know, maybe there is some mandatory licenses that you need to have. And the answer that you get is, well, the owner doesn't pay himself a salary. He gets it as a dividend at the end of the year. And, well, that's already a different, or the P&L doesn't match because it doesn't include all expenses. So what you'll need to do is adjust the P&L that you have and add maybe a fair salary. So let's assume that you can hire someone else to run this business or to be the chauffeur, and you're going to pay 60,000. I'm just making up some numbers. So now what happens is, the initial proposal was 204. Now what you have is you have the profit before tax being 25, the net profit being 20,000. So the actual fee that you're paying is 10 times. Now it's not 3 times, it's 10 times. It's much more expensive than initially presented. Now it's not that this was hidden, is that it just was not there. The earnings were not withdrawn as a salary, but at a dividend at some point. So accounting wise, of course, it will not be in the P&L. Hey, James, welcome to the stream. So now let's take a look at another side. If you take a look at the chauffeur, right, he has been around for 30 years. He's been running this business for quite some time. And if you take a look at what you're acquiring, like this one, you can inspect, you can take a look at the car and figure out if you need to replace it with a new one at maybe the next year or next 5 years. But then it's this one. Now, what if it turns out that he has 2 clients in total, and then one of them is in his 60s? Now it's a completely different picture because probably that client will not be a client for a long period of time, and you'll have to be on your own. So now what you have is, do you want to pay 200,000 for a business where even if you hire someone brings 20,000, and which is basically a 10 times P, but even this part is quite uncertain because one of the 2 clients will be gone over the next 2, 3, 5 years. So even the 10, it might look or it might be actually a lot worse than it is being presented. So I think these are very niche cases, but you can find them not just in small companies, but a lot of this is being used in public companies. Every time that this is one of the reasons why there's a disclosure where the public companies have to disclose if any customer accounts for more than 10% of the revenue. And in some cases that could be seen as a risk, but in some cases it's quite good. So for example, I was looking at, I think last year at Cal-Maine, one of the largest egg manufacturers in the US, and I think Walmart accounted for about 1/3 of its sales. Now, you might say, well, 1/3, 30%, over 30% it could be seen as a risk, but Walmart is not going to replace its largest supplier of eggs overnight. They're likely quite thrilled to have one customer or one client or one supplier in this case bringing so much to the table. So it's up to you to judge. However, on the other side, if you have a company that's manufacturing shirts, when there's no moat, there's no leverage, and they have one of the big retail companies or fashion houses as a client, then that's completely different because they can replace them quite quickly, and they have the other side, the fashion house or the the retailers have all the leverage. So this is something to be looked at from various points of view, not just one. As in, I'm looking at the P, because in this case, let's not forget, the P was 3. It turned out it's not 3, it's 10, and not only it's 10, even the 10 is completely uncertain. So just keep that in mind when you're looking at individual companies. And even another example would be, do you think there's a way to figure out why the person is selling a given business? Yes, that's a very standard question that is probably the first question that is being asked. And there is always a good story. Most of the times it's a true story. Most of the time it's just person retiring, so it's not unusual for that to happen. But here's, for example, another example. This is, I think, a simple one from accounting-wise, at least to follow the numbers, but deep underneath, it's quite more complex. So this is Nokia. I'm sure that most of you have heard of their phones that have been that could be used as a little weapon, or at least it could have been used in the past. But take a look at these 2 years. So take a look at the net earnings to the company. It went minus 2.5 billion to 4.3. And if you take a look why, this is the main reason: income tax expense. There was a year with minus 3.3 and a year with plus 2. And take a look at the profitability before and after. There were no years with those kind of outliers. And the reason for that is very simple. And I'll go back to my sheet for a bit. So if you think about taxes, right? So if you have year 1 where you have, I'll just use profit or loss before tax. So let's assume that a company has loss of 100,000. Depending on the tax regulation, you are allowed to use that loss and not pay taxes if you have, let's assume that you have 80,000 profit the next year. So what will happen is you carry forward this loss from year 1 into year 2, and instead of paying taxes, you don't. After year 2, you use most of the losses from the previous year, and you even still have 20,000 to carry forward to year number 3. So what will happen is, if there's a tax, let's say the tax rate is 20%, basically what you'll be saving in the future is about 20,000, right? So 20,000 taxes you'll pay less sometime in the future. But for this to be recognized as a tax asset, there's one criteria, and that is you need to be profitable in the future. Because if you're not profitable, then this is irrelevant. You'll never have that as an asset. You're never going to use it, right? So this is the criteria. So what happened in here, up until, I believe it was 2020, yes, up until 2020, up until here, 17, 18, 19, Nokia expected that, and I believe it was in Norway, it was going to have profit in the future, so it can use this loss from the previous years and use it against future profits. What happened in 2020, maybe that was part of COVID, but they couldn't prove that in the future they'll have profits. So these losses that they have accumulated in the past, they had to remove completely out of the balance sheet. So the deferred tax asset position went down. They had to recognize it in the income statement, and suddenly take a look at in here, income tax expense 3.3 billion. That's it. Incredibly terrible performance. 2 years later, because this is something that is being done every year, and for most companies even every quarter, they reassess the situation and they figured out, well, wait a second, now the business has improved, and now what we can do is actually use all those losses in the past, use them in the future, because the future looks bright and we will have profits in the future. So what happened is everything that was derecognized was gone as an expense. Now we bring it back into the equation. So if you take a look at the net income, it was 4.5 billion. Like this number, if you take this number and use that as a basis for the price to earnings ratio to judge if a company is fairly priced or cheap or under, this is not the right metric to use, because there will never be a year with 4.2 billion. It's an outlier, but there's a reason for that. And unless you've gone through the work to figure this part out, I mean, you just end up with a completely incorrect assumption and conclusion. So, what adjustments do you make to net income other than R&D one time, etc.? So, to be honest, it depends. If you're looking at a small business, then I just question everything that's material. Everything that's, whether it's on the balance sheet or the P&L, it's just what is material, and to figure out, is that how the business will look like in the future? Is that really sustainable? Because what could also happen is that there's a temporary reduction of personnel that will be actually needed in the next year, and you don't see that in the P&L. If you take a look at the large companies, there's rarely that I look at. There's very little that I do when it comes to adjustments. Other than if there is some sort of extraordinary event like this one. But what is more important, what I question the most is the adjustments that they make. I think most adjustments, yeah. Like, I'll give you another example. Speaking of adjustments, take a look at Pepsi. One thing that is being considered extraordinary or unusual is restructuring. You don't expect a company to have restructuring every year, right? It's, if you restructure for whatever reason, that should be it, right? This is the unusual items part. So up until this is the merger and restructuring. Take a look at it. It happened every year over the last even decade. It's not unusual. If you take a look at Coca-Cola, the very same thing happened. Take a look at this. Merger and restructure, exactly the same. And the explanation is very simple. These are companies that have quite a significant global presence, so that there's always something going on. It's in one country or the other. Maybe they need to figure out a better way to streamline their operations. However, if you assume that these are unusual or one time and you adjust for them, obviously you're wrong. So if you read the management commentary and there's the word one time, or even if it's an impairment, try to figure there's a reason why there's an impairment. Goodwill impairment is a great example, right? Goodwill impairment is a proof that the company overpaid an acquisition. So they made a terrible decision, and I'm not sure if I'm happy to share a little bit about that. But what happens is, when there's a company being acquired, right? Let's say company A acquires company B. So what happens is, company B has certain stuff on the balance sheet, right? It has the PP, it has some intangible assets, it has liabilities, just everything that's on the balance sheet. And what happens in company A, when it consolidates everything, all of this that is being owned by company B moves to company A. So let's assume that they had 100 in intangibles, 20, and then minus 20, and then that was the equity, right? So this is, I'm simplifying this. So let's assume that this is how it looked like. So this is the assets and the liabilities and equity of the balance sheet. And let's assume that they are paying 120. So if they pay 120, right, company A, there's a cash outflow of 120. But what do they get? They get this part minus this one. And if you put everything together, that's 100. So they paid 120 to get 120 in PP and intangibles and 20 in liabilities. I'm just simplifying. Of course, there's inventory, there's receivables. And what cannot be explained through the balance sheet, that is the goodwill. So in this case, there will be 20 in goodwill. So now what I have is 120 out of the balance sheet, 120 on the balance sheet again. So what is goodwill impairment? Well, they need to justify this 20. How do they need to justify that? They need to prove that what they acquired is worth the 120. So they can have a DCF model, for example, where company B, the profitability goes into year 1, 2, 3, and so on. And then there's a DCF, and then it proves, yes, it is worth 120. Right? That's one approach. The moment that there's some sort of a change in the input, and this model is no longer applicable, or at least the outcome is lower than what they paid for it, then this is the first thing that is being removed, unless it can be, like, for example, if the PPE gets damaged, of course, that's what gets written off first as impaired. But if the business deteriorates as such, then at some point goodwill gets impaired, and that basically means we overpaid. This company B was not worth 120; it was worth maybe 100, maybe it was worth 80, right? It depends. But this is, in a nutshell, what goodwill impairment does. And in my opinion, companies that have significant goodwill impairment, and often they should not be engaged in acquisitions because obviously they're doing a terrible job. And even there are studies that acquisitions have been one of the quickest way to destroy shareholders' value, because it's one decision, it involves quite a bit of capital, and if it is done wrong, and oftentimes the reason why it's done wrong is there's synergy. This is the magic word. It means we can do more together, which it doesn't happen. It doesn't happen for many reasons. It doesn't happen because there's too much optimism. There are too many ideas of how these companies can work together, and sometimes it doesn't happen. And I'll give you an example of I'm not sure how to phrase it, but this is a story that I've heard from a manager of mine. Back in, I'm not sure if it was in the 2000s, somewhere in the 2000s, or maybe a little bit earlier, when Pricewaterhouse and Liebert & Cooper merged. Those were two really big consulting companies. They merged into one, and what they did was they organized an event. Like, hey, let's put all the employees together and let them hang out with each other. They can meet each other, and just make friends, explore the other side, and just make sure that there's a bit of mixing in the culture, in the ideas. The only problem was that they had some sort of bands, like wristbands, and they were colored. So if you were from one of the companies, you had a blue one, and if you were from the other company, one of the other companies, you had a yellow one, let's say. And what happened is, 5 minutes later, it was like Moses went into the room and it split into two. So the idea was good. Let's make sure that the people meet each other, but the execution was quite poorly because everybody was just with the people that they knew, and that's not the right way to do it. And something like that happens also when acquiring companies, because if in company B you have employees that dislike company A, the culture, or maybe they have different ideas of how it should be run, and they do not accept the new ideas from company A, and a lot of people leave, or there's something that's incompatible when it comes to the system, when I mean the system, I mean the way the business operates, like sometimes even sending offers, like they could cross promote to each other's customers, that could actually backfire. So just because you read that there's synergy, it doesn't mean that there is. There are ideas for synergy, and those ideas are being used to justify the cash outflow, but it doesn't mean that there are actual ideas that will work. They might work. So just keep in mind, if you see a big acquisition, just be careful, because oftentimes it's not a good one. Oftentimes, and obviously for larger companies that acquires really small companies, then the impact is insignificant. But yeah, there have been many examples when they backfired. Must be a lot of trading going on just this concept alone. Initial overvaluation after merger, which then falls. I've seen many mergers where the share price falls on the announcement. So in this case, company B's share price, if it's a public company, would go up because every time that there's an acquisition, it's being acquired at a premium of, let's say 10, 15, 20%. That's kind of the low end even. You could even go up to 40, 50%. However, oftentimes company A, if it's not a company that is being perceived as a good fit or overvalued, then based on that news, the share price goes down. But I'm not sure if it is really something that can be used for trading, given that the moment that it is a public information, it is almost immediately reflected in the share price, unless of course the market thinks it's a good idea and you disagree, and it actually has an impact, a negative impact that just the market doesn't know yet. So I missed one comment earlier. Do you like Uber as a stock pick? Baron seemed to hype that one stock in the year review. I'm really one thing that I'm a little bit torn when it comes to Uber. And I'll come back to it, but I want to give us a comparable example. Back in maybe a few years ago, when the battle between Netflix and Disney was a bit more heated, there was one theory that the more streaming services there are, and then of course Amazon Prime, at some point what happens is the consumers, instead of subscribing to 5 different platforms, they'll just decide to just go and pirate stream and basically just do it illegally, because it's not worth it. If you combine the memberships of all the platforms, then you might be paying 50 or 100 euros or $100. So that was the idea. But these are services that compete with one another, and I don't think that has happened. I do think that customers subscribe to multiple platforms. Now, when it comes to Uber, this is not a service that is being offered. There are competitors, but it's not the customers that have to choose. They get the opportunity to choose one. They just need to choose one, and the one that they'll choose is the one that's cheaper at that point in time. So from a customer point of view, probably it's a good, of course, it's a good technology to be around. I'm surprised that it just doesn't create too much value for the drivers. I mean, that's where I get a lot of negative sentiment, and obviously the company has done outstanding job when it comes to the profitability. They have captured a significant portion of what goes through the platform, but I'm really surprised again that they're not focused too much on the drivers. I would expect that. I think they should focus a bit more, and that's if the thesis with Tesla is always their self-driving, which has been there for a long time. I do like Uber as a company from a financial point of view. I'm not that big of a fan from a social point of view, from a driver's point of view. But yeah, it will be around for a long time for sure. I mean, I don't think it will be easily disrupted. After all, it has this network effect where it has all of these companies on it, also for Uber Eats, right? So I cannot imagine that they'll be disrupted any time in the near future. So I'm not sure again if they're adding value to the drivers. Probably they're for sure adding value for the customers, and it's if they have pricing power, then they can just raise delivery fees over time and just even improve their margins. Uber seems a bit exposed to potential labor union regulatory risk. Could be. I have not seen much of that happening. In terms of drivers, it is not the same as workers at Amazon. Yeah, I mean, yeah, and there, Rose, and I see there a lot more automation through robots. I think Amazon is one of the companies that is benefiting the most out of automation by far on the entire planet. The number of robots they have active, it's crazy. And yes, they have also a lot of employees, but if there's one company that's going to benefit the most from automation in the physical world, I don't think there's any company that comes close to Amazon. So, it will be interesting to see how the future unfolds. You can also argue that Tesla has a potential, but I'm not that convinced with the Optimus for a different reason. I think that it could be sold as a product to companies that look for automation, but I'm struggling to envision that as a household. Not sure if companion is the right word, or helper. The reason why I'm saying that is I think there's a lot of storytelling going there, and if you think about the pitch that was done by Elon, probably maybe in the last presentation, one of the things he mentioned is that will be a product that almost everybody will have, and it will clean for you, or do the dishes, or I don't know, lawn your mow, or mow your lawn, or I don't know, vacuum your house. But robots of that kind already exist. So if you think about vacuuming, you can get a Roomba and it would cost you $500 or 500 euros. So why would you pay 20,000 for a robot? And that's the price point that he mentioned. At some point in the future, you can get robots that do those niche tasks and it won't cost you 20,000 combined. And then there was, well, yeah, but it can do groceries for you. Well, you can order groceries and it would cost you like $5, 5 euros as a delivery fee in most countries. So if you order once a week, it's 50 times a year, roughly, and maybe sometimes you just want to do it yourself. That's still not much. So I'm not that convinced that even at a 20,000 price point, which is something that is being promised as a long, somewhere down the future, not the near future, I'm not sure if that is something that is worth it. And to assume that, oh, it can work for you, as in it can actually take physical job for you. Let's assume that is possible. Let's assume that you can buy a robot for 20,000 and it can work for you and bring home more than 20,000 a year, or well, why wouldn't the company just buy that? Why would the company let you buy the robot and basically have it done the work? So I just don't see fully that this is, and there's a lot of competition. I see a lot of companies innovating in this field. The only thing that I'd like to envision is a future where a lot more is done by the robots and humans can actually enjoy life a bit more, because I do think a lot of individuals are focused on just work and not really enjoying life as is. Slightly different question. Do you think US market is overvalued, and also any expectation of the US stock effects of Trump coming to power? Honestly, I don't think it's overvalued by much. And I don't think predictions on Trump make a lot of sense. For most individuals and most companies, change in presidency has very little to no impact. So probably what will have more impact is if there are some sort of tariffs. But other than that, so unless you have companies that are really exposed to certain tariffs, yeah, I don't think so. I don't expect too much change there. Optimus will be targeted to the elderly. I think it will be able to monitor all vitals and assist them with walking, etc. Yeah, I fully agree in terms of for the elderly. So I think from a high level point of view, I find the elderly care to be one of the two industries that needs more innovation. I'm not sure if for sure it will get a lot more innovation, because if we have more aging population, and it's not just that it's aging, it's the second, I think, factor is that the parents and the children are not as close together as they used to be in the past. In the past, there was less migration from one city to the other, from one country to the other. So when somebody got to a certain age, let's say over 60 or 70, there was someone from their family nearby to help. Today, I don't think that's the case as much. A lot of the younger, or the children, the children of who are now elderly, are somewhere else with nobody to take care of, and sometimes they have no children. If if we have a population that's aging, at some point we will have more elderly without anyone to take care of them. So yes, I do think that the elderly care sector is one that will see significant growth in the future. And I've looked at a few companies that provide that kind of service, but I didn't see anything that seemed too impressive. I do think that there's a huge opportunity there, and definitely for maybe assistance with robotics. I'm not sure if it's, again, monitoring all vitals. I'm not sure about that part. I think that a lot of that already exists. I'm not sure if Optimus should be focused on, or maybe it would be a good addition, a feature, but assisting them with walking, well, you can argue that there are already wheelchairs and some sort of assistance, but maybe it's maybe it's all kind of services related to taking care of elderly. So that's something that's very interesting to monitor. Well, the second one, that because I mentioned that's one of the two industries or sectors that I think will do or need a bit more innovation. I think the second one is um, I see a lot of young people that are kind of living online more than they live offline in the actual. So this virtual reality, augmented reality is great, but this actual reality is quite good. And if they focus on the online reality and they get at some point disappointed, and it's not a question of if but of when, given that all the social media out there is selling some kind of a dream, or you see people doing well, and if somebody's not doing as well, even though obviously it's a fake world with fake impressions, so that's not the reality. It's difficult to cope in reality, and I see a lot of people just being completely lonely in the actual world. So yes, people can play games and they can be on Discord and they can connect in very, very, very various different ways. But ultimately, what matters is maybe what equally matters is connecting in the actual world. And I don't think there is as much feeling of belonging in a community, and that's so whoever comes up with some sort of a solution to connect the people, just especially the young ones, but all just in general people in real life, and help with that loneliness feel, and just maybe take the attention out of the social media and the online world. I think that there will be there's a lot of value there, not just from investing point of view, but purely for the society. What are your thoughts on serial acquirers? I mean, it works for those that have experience and they can really target good deals. I think that there are many serial acquirers that do well, and the best part there is you have a lot of or enough track record to figure out if they're good or not. So if it's a serial acquirer that has just started, I'd be more cautious because maybe they'll rush to get a deal because they want to get that track record. But if it is some that has been around for a very long period of time, then it's much easier to judge based on the performance. For the next 5 to 10 years, do you think US market outperforms will continue versus the rest of the world? I don't think this is a yes or no question. I think it's more of a question which parts of the world. So, for example, if I take a look at Europe, I don't see any significant improvements that bring new companies that are valuable to. So probably most countries in Europe will struggle, but that doesn't mean all companies within Europe. Probably some developed countries will do much better than the US. Maybe India is one of them. I mean, it's still a country that has quite a population that is still not fully utilized, not fully value creating. So I would not say that US would continue versus all of the world, but against significant portion, yes. Unless, of course, there's like a significant event like the World War or something. That in that case, I mean, probably none of this is relevant. Also, thoughts on discount rates. How are they used in practice? Have heard opinions about the uselessness of cost of capital and the lack of full academic agreement on what a good discount rate is. That is a good question. I don't fully follow the cost of capital as the output of predefined input, for a simple reason. The input can be flawed. If you take a look at Zoom in the pandemic, it had a negative beta. So if you were to use the weighted average cost of capital, the whole formula, basically you had a discount rate of, I don't know, I think like 2% maybe, which I don't think anybody would be happy with a 2% discount rate. So if you were to use a valuation model with that discount rate, yeah, you would have had a crazy valuation. So I don't think that deserves. It should be blindly used. I don't think also on the other side that it's completely flawed, as in the rationale there makes sense. if you have a company that operates in a safer environment, for example, versus a company that operates in a less safe environment, of course you should be able to, or you should pay more for the one that's operating in a safer environment because there's less risk. And the country risk premium, for example, might take that into account. But I do think that a lot of the adjustments should be based on your rationale, not the model itself. So if you have two companies where one has 50% exposure to one client and the other one has all diverse clients, then this one with one client having or 50% of the revenue, bringing 50% of the revenue is more risky. But you won't see that in the cost of capital formula for a very simple reason, because it's not an input. So I do think that you need to figure out what is a fair discount rate based on your own analysis. You can use some sort of model as a guidance. What would be interesting to see as input, but I wouldn't blindly use the weighted average cost of capital because there are, again, a lot of flaws. Are you still bullish on PayPal? I think it's already fairly valued, more or less. I don't think there's a significant upside for now, personally. But it did quite well. I mean, it had a really good year, and the new CEO has done quite well. I think also he's being active on social media and brought a bit more positive sentiment. I'm not sure how this honey scandal will unfold. Maybe you're familiar with that. There was this browser extension that turned out to be changing the referral links from the influencers to their own referral links. And not only that, but the discounts code that they shared were not the best ones. So I do expect some backlash there. I don't think it will be too significant. There will be for sure some fines. The question is, are the users going to be so pissed at Honey and PayPal that they eventually boycott PayPal? Again, unlikely, but it's not a zero probability. One that I've recently been adding more is Match. I think it's an interesting company. But again, personally, that's not an investment advice. Or I'm sharing everything that I'm looking at on the Substack. I probably leave a link at some point in the description. But I've really enjoyed researching. I mean, I've always enjoyed researching companies. The thing is, if I am to record a video, it takes a lot more preparation. I need to make sure that it's not just correct, as in all the numbers make sense, but also to make sure that there's good flow between segments, that it sounds nice, and then eventually I need to get down to the editing part and the thumbnails, and it takes really a lot of time. So instead, I decided to just move to Substack and share my thoughts in a different format. Ultimately, the outcome would be comparable, but I do understand it's a different medium, and some people would prefer to see videos. So that's why I have these live streams where we can talk on various topics. Any thoughts on credit card debt in the US and how it may affect purchasing power of specific markets? I'm not sure. What do you mean purchasing power of specific markets? Do you mean, for example, retail versus larger purchases like cars and houses? In general, I don't think that the US has, for quite some time, had quite a poor relationship, or the Americans, with personal finance. I always thought that they have way too much credit card debt. I would definitely not be comfortable that way, but I don't think it has too much effect now. When inflation goes up, or when there is inflation, at some point that is being reflected in the salaries of the individuals, which means the debt can continue to grow at the same pace as inflation, and they'll be back to the same point where they started. Of course, the only part that's really difficult right now is probably the real estate market. If you have 7-8% rate on mortgage, 7 to 8% interest rate, it makes buying a house really expensive. and the prices remain the same, because if you bought a house in 2017, 18, 19, when the interest rates were really low, then you have no intention to sell that house or an apartment and replace it with a bigger one, but get a 7 or 8% interest rate. So it's, first of all, there's very little demand at these rates, but equally important, there's very few who are willing to sell their houses if they already have a mortgage that has quite favorable interest rate terms. So once the interest rate is down to, I would say, at least 2% from now, there will be a lot more transactions in the real estate market and all the services related to that. But we're far from that. My issue with Match is that its model contradicts with the point of sticky customers. Yeah, I don't. Do we want people to stay on dating apps and make profits, or let them find the right match and leave the app? Obviously, the most beneficial for society is the second one, right? Find the right person and leave the app, 100%. But I'm not sure if Match is what stops them from that. I think if it wasn't Match through all its apps, it would have been someone else. The question is, who is going to connect them the quickest? And I think Match does the best job right now. And the question is, what can disrupt them? I'm not sure. What would be a better way to connect them? Because that's what they are looking for. They're looking for fast connection. That's it. Also, the recent issues of dividend does not speak of ideas on how to allocate. I don't mind the dividend. I mean, I think they could have done also quite good with buybacks at this price. But I don't hate the dividend part. I'd rather have the dividend than buy another company or another platform that does what they do. I don't think that's going to be too. They'll create too much value. Palantir overvalued in your view? That's a difficult question. So I looked at Palantir. I think it was maybe 3 years ago now, and I back then I thought it was not fairly valued. And what I missed, there were two things that I missed. The first one is their approach to sell their products was completely different with the free demos that attracted a lot of potential customers. And they managed to convert way more than I expected. So that's number one. And the second one is that they managed to get to profitability much quicker than I expected. So from a sales point of view, I wasn't that far off, but profitability-wise, 100%. So I didn't expect them to get this profitable this quickly. But is it overvalued? I'd say it depends on your assumptions. I would say yes, because I don't expect them to grow at 40% every year for a decade, because that's basically what the current price implies. But if you think that can happen because of their connections, right? I mean, after all, they have not just Alex Carr, but Peter Thiel is also part of the company. They have connections with the new administration, so I don't know. It could happen, but I still think the current price is quite high. That doesn't mean it's significantly overvalued. I would not bet on it for sure. I would not short it. I would not buy it either. So that's the beautiful part of investing. You don't have to act upon every thought that you have. Was looking at the beaten down stocks. I still find Boeing significantly overvalued and Intel quite fairly valued. Any opinion you hold, or any other beaten down stocks you're tracking? I have not looked at detail at Boeing. I know they had a lot of issues in the last few years, but I have not looked at it into detail. So I can't share much there. Intel is one that I was looking at. What was it? Let me see. I was looking at it recently, and I remember it had been at the same level. Now take a look at this. $19. It was at 19 somewhere back in 1997, 1998. So 1997 even. That's crazy for how long it's been at this price. Like, sure, you could argue dividends and all that stuff, but that's really, really poor performance. They have to reinvent themselves. They have to figure out how to do better. So yes, you can argue that it's fairly valid just because the price is down, but this is a tough company to value. I mean, they have potential. I mean, they're still a giant. They have capital. They need to. I know that wasn't that didn't they have a new CEO recently? Oh yeah, here they have a new CEO, right? Even co-CEOs. I've not followed it recently, December 2nd, so it's recent. It's a recent change. It would be an interesting one to see. But any changes that happens from a management point of view, it would take at least a few quarters until there's any impact on its not just price, right? Share price will follow up eventually, but just on the fundamentals of the company. I was thinking about general retail markets or even larger purchase cars where growing credit card and debt and interest on top. It stops someone from being able to make non-vital purchases much. Yeah, I don't think there will be significant year-over-year increase in larger purchases when it comes to cars and houses. I do think that it will. Most people are waiting for interest rate decline. What? But think about this. Even if you don't buy a house or a car, most people would still need one or the other. Like, you could buy a van and have both, like a camper van or something. But what that means is, if somebody doesn't buy a house or an apartment, they need to rent. If somebody doesn't buy a car and they need one, they have to lease one. So maybe companies that lease cars would do well. Like that's the alternative way of thinking, because one way or the other you have to have the asset, right? And especially in the US, as everything is there, the public transport is, I don't know if non-existent is the right word, but it's close to that as far as I know. Hi, sorry if you already touched on this point. Any thoughts on the S&P 500 performance in 2025? Yeah, I started the stream a little bit with the following information. So these were the S&P 500 targets that are shared by the big institutions out there. So they're expecting plus 20 or plus 9 to plus 20%. It's an estimate. Let's say an estimate. The problem with this is, if you take a look at their predictions of last year, they were quite off. So these black circles, they were their initial predictions. So let's say 1 year earlier. This yellow dots around, actually the year ended a little bit before that, so 5.9, 5.8 for the S&P 500. So they were quite off. Then in October, they updated their targets, and take a look at the gap. So we're talking about 10 months, 11 months of gap. So if the biggest and best financial institutions with the best analysts, obviously that would be in quotes, have these predictions and have been off by so much, then I don't think it just proves that forecasting the short-term price movement is just a guess. That basically there's no point in doing that. There's really no point in doing that. Instead, and I don't attempt to do that. I mean, the best guess would be the historical average of like 10%. If you do that every year, then you'll be on average, you'll do better than the analysts probably. Intel price to book 0.8. Yeah, again, the book, also the book one is the book value. I don't look at it as such. I do think it can be misleading. Maybe I can give another example there. Let me take a look at that. It wasn't big. Another company that was. Let me see if I can give you a quick example when it comes to the book value, because I think that is also one that. What is the? I want to give a quick example, because I do think that this is. There was big lots in the past that you could make the same case. Is it already? So if you think about the book value, though that relates to the accounting value, that doesn't have to be equal to the market value. So book value would only be relevant, and I'll argue that this is only relevant or mostly relevant when it comes to liquidating a company and taking everything that's on the balance sheet and just getting rid of it and then collecting the difference. But what's on the balance sheet does not mean that that is the fair value. So let's assume that there is a company with a billion in inventory. If you can't sell it for $1 billion, if you can sell it for 800 million, because who's going to buy all of it at once? Probably you have to sell it in bulk to a competitor, and they'll have all the leverage because, well, they don't have to buy, but you have to sell. The book value goes down. So the real value is not really the book value. So it's most of the time that you have an adjustments down, not an improvement. Intel is very interesting in terms of whether the government will save it. For sure, yeah. But again, there's a lot of uncertainty there. Also, industry-wise, everywhere I read, clients prefer TSMC because they are client-centric, while Intel is a difficult supplier. And if you don't have clients, you can't scale R&D. Being client-centric definitely helps. If you don't have clients, you can't scale R&D. I'm not sure if that's I don't fully agree with that. It's probably that you have to figure out how to fund that. But it's definitely an interesting time for them. Google still seems to be the most unloved in the Wall Street among Magnificent Seven. It seems to be the least overpriced compared to Microsoft, Meta, Amazon, Tesla, Netflix. Maybe on a relative valuation. I'm always surprised how slow Google were with coming up or sharing their LLMs. Their Gemini has been very, very, very slow. I was expecting once ChatGPT was out that it wouldn't take them more than 6 months until they come up with something that's at least comparable. What they came up with was terrible, and it took them a lot of time to catch up. But ultimately, the question is, how does search look like 5 years from now? Because I use Google, but I also use ChatGPT. And I don't think that I'm using Google as much as I did in the past. I do think that the number of Google searches I do have decreased. So, that's a sample of one. That's just myself. And the question is, if you take a look at the younger generations who are now using ChatGPT a lot more for homework and all the stuff that they shouldn't be using it for, is there a trend? And does it mean that in 15 years from now, or 10 years or 15 years from now, that ChatGPT would be the default where they go to and search for stuff, and Google will not have as much traffic? Because if that is the case, then of course the value of Google will or the revenue that they generate will slightly go down. However, Google doesn't. Of course, it's search, right, that generates the money, but it's not the users that search that bring the money to the table. It's the companies that use Google to advertise their products and services. So what that means is, if you have two companies competing for fewer customers, the cost to reach those customers would go up because they have to overbid or bid against each other. So if it becomes a platform, obviously there will become a point that where some companies would say, well, this is too expensive for me to advertise, and I'll try to figure out another way to do it. So if it comes to that point, then the question is this price increase or the cost of advertisement offset the number of searches? If it does, then there's barely impact. But what are the alternatives? The alternative is Meta, right? So advertising on Facebook and Instagram. Another alternative is Reddit. Another alternative is X or Twitter. And if these other platforms can provide better value, then Google would be losing over the next 15, 20 years. Again, under the assumption that more users are using alternatives to Google search. And for YouTube, I'm not too worried because I do see YouTube being used by all ages. So it doesn't seem that it's skewed too much towards one side or the other. So yes, it might seem, relatively speaking, least overpriced compared to the other companies in the Magnificent Seven, but it also has a lot of uncertainty in the future. And unlike Amazon, that has retail, it has also cloud. It is really search focused, and that's where majority of the money comes in. And if that part is being disrupted to some extent, then it's completely different. And then looking at ChatGPT, I mean, sure, it was a big hit when it was introduced, but as far as I know, it's not profitable, and it still needs to do a lot of work to get to a point where it's self-sustainable, even, because the cost is much higher than the revenue that they get per user. And of course, there are a lot of free users, and they don't run any ads. Book value is usually relevant for financial stocks. Like even there, I mean, in general, just book value can be a tricky one. So I would never take any number when it comes to the balance sheet as for granted. Just try to figure out if there's something to question. Any thoughts on the bond long-term yield increase in UK and US? I mean, the yield increasing just suggests what the market participants expect for the future. So increase, it's in general not that good. But I could be wrong, right? I don't focus too much on that. When I'm picking companies, I just focus on the companies and figure out, can they survive in the future? And how is the company going to look like 5-10 years from now? And that's it. It doesn't seem to show up in the search numbers, though. I assume you're referring to Google. Of course. That's what I meant in the next 5-10 years. I don't think it's going to show right now. But if you have, if the older population is being replaced with younger generation that are now in elementary or high school, and they're just focused on ChatGPT, or basically being raised with ChatGPT, then they just see the value of ChatGPT, and it's maybe the outcome of their question is a lot more detailed compared to searching for Google. Because if you search for Google on Google, the first few results will be sponsor posts. That doesn't mean that those are the best results. So you have to search or scroll to figure out what is the best deal. ChatGPT doesn't care about selling you anything. So maybe it would. I mean, it's. That's the uncertainty, and I think that's the reason why it is being priced lower relatively to the other big companies, because of this uncertainty. Aside from stock picking, do you invest in ETFs? And if not, would you start at some point while investing in individual companies if you underperform, for instance? I do not invest in ETFs right now. So far I'm outperforming, so I'm happy with that. If I underperform, I mean, I haven't really thought too much about that, but I think rationally makes sense to invest in ETFs if I underperform. Otherwise, maybe have a small percentage of the investing portfolio for stock picking, but obviously that would be more for fun, and the underperformance would have to be compensated by the fun that I have. I mean, fun is important, but if you can have fun and outperform, I think that's the best scenario. So I don't have ETFs yet. I don't see a reason for that for now. But again, if the performance significantly deviates over long run, then of course I'll definitely do it. Why not? What I do right now is I do deposit at least once a month. It depends on how much time I have, and then I just allocate the deposit to the existing positions. So I'm not sure when was the last time I had a new position as such. I don't know, it's been months, but I have very little portfolio turnover. Just most of the time just adding to the positions I have, and I'm happy with that. So it's maybe a lazy strategy, as in I don't have to do a lot of research into new companies unless I have time, and I do that now. Most of the time I do it just to understand a new business. I'd like to understand how a business works, how a business has evolved over time. Sometimes the history of the business is really, really interesting. It teaches a lot of lessons that, if history repeats and you know those lessons, then maybe at some point you can benefit. There was an interesting case. I need to check quickly, but was it Volkswagen? I think I can quickly find it probably. So somewhere in the 2000s or 2010, somewhere there was a gas emission scandal where I'm not sure if I can find that quickly. There was a gas emission scandal. So a large automotive company was being caught that had this device, and I'm quite sure it was Volkswagen. Again, I'll just go gas emission scandal. Basically, what they did was they had this device in their cars, and what happened was when they were being tested for gas emissions, the numbers were lower than they actually were. So the cars were aware of the event that they were being tested. So what happened was, the results were fake, obviously, and the company was found guilty of that, and they were eventually charged, and there was a fine. The thing is, the share price went down quite a bit that day, and I think it took maybe a week or 2 weeks to fully recover. And it's not the first time that happened. Not with Volkswagen. There was another company that did it before, and the same thing happened. So the result was quite clear. These companies, despite being caught in scandals, number one, the fines are not as crazy. So in a rational world, the market cap should decrease by, if the market is efficient, the share price or the market cap should decrease by the amount of the fine. So if it's a 1 billion fine, it should go down by 1 billion. Oftentimes the reaction was much stronger. Why? Because it was perceived that now the customers are aware of this scandal, and well, they would not buy their cars anymore, which obviously that isn't the case. And if you take a look at, walk to a person who has a Volkswagen and ask them if they know about the scandal. First of all, either they don't know, or second of all, they don't care. They care about, can I get a car? Yes. What are my options? And eventually, they just want to find a good deal. That's it. So if there has been a scandal, okay, it's a short-term memory that the consumer doesn't really care about. It's more that the investors perceive this as a big event where the value should go down. In reality, if the sales don't go down, which it has been proven that they haven't because of these events, then this price movement is just not justified. How many companies do you have in the portfolio? Are you concentrated? Are you concerned about diversification? I think I keep it around 10 companies in the portfolio, but I would argue that that's still diversified. I mean, I can quickly have a look at the companies, or at least count down. But the industries are quite diverse, so I'd argue that's still quite diverse. Yeah, I mean, there's a little bit of tech. There are small caps, there are large caps. There's retail. There's Amazon as well as one of the biggest tech companies. So it's a little bit of everything, but it's enough. I would say it's enough. So it's exactly 10 companies in the portfolio. But I'm not concerned as such. I think 10 is enough. I would not feel comfortable if I had 2 companies in the portfolio. That doesn't mean that that's wrong. It's just that personally I wouldn't be able to sleep well if I had 2 companies in the portfolio. But yeah, I mean, 10 is quite good. Are you actively searching for new stocks to add, or are you leaving it as it is and analyze companies based on a nice pitch you read somewhere? So the ideas are everywhere. Social media for sure contributes a lot. the ideas are definitely there. I want to. I don't go after every single company. I want to make sure that it is one that, if I like what I see, eventually I would invest. So, for example, insurance companies, I'm not interested in. So even if there's a great pitch there, I wouldn't. I just won't waste time. Gambling companies, I don't care about valuation. I'm not interested in that. Tobacco companies as well. So there are certain sectors or industries that I just don't care about, and I'm just completely not interested. But if there are some companies where there's something interesting and I would invest in it, then I'm willing to dig deeper and figure out how much is it actually worth. What can I expect in the future? There has been a lot of that, but most of the times the research ends at some point because of the valuation or because I see some sort of a red flag. Like, if they had 3 CFOs in 2 years, something's going on, right? Which companies do you have in your portfolio and why? Maybe I'll leave that for another time. The thing is, I used to share my portfolio every month, and it got all the attention versus all the other videos, which was not in the intention. I didn't want to be seen as somebody who has everything figured out, because I haven't. I do well, but maybe there's a lot of that can be attributed to luck. So I just wanted to keep this channel more educational and just cover all kinds of content that I think it would be good to know. So let's say it would be good to know, and it could help others. And what I invest in, like, I don't want people to do that or to invest in those companies just because I have invested in those. I think that's also a poor strategy. Adani was similar, where the price dropped and recovered. Adani wasn't there a Hindenburg a research report, or was it another one? Yeah, I think they were the ones, right? There was a short report on it. Yeah, January 2023. So the drop was due to that. It's still down, by the way. It's still down like 40% since then. I was just looking at this one. So they had this Adani group. By the way, Hindenburg are a great source for I wouldn't say getting ideas per se, but more understanding their rationale. I think they're really good at writing their research down, laying that down. And now recently it was Carvana. That was the latest one. But this is what happened. This is their pitch. So somewhere in January, this was the drop, 60%, and now it's still down. So, but yes, if you have put down here for whatever, it's down, it's up 60%. I'm not so sure if what I say. If there's smoke, there's fire. So probably there's something going on in that one. I was not too convinced with the share price, but also I think the report was quite well written, and the share price is also quite significant already. Do you follow financial news on a daily basis, and if yes, what sources do you use? I don't follow it on a daily basis. I do use Twitter and Reddit as well, but I'm not the most active person on either of them. Sometimes if I have something to share, I just log in and just share, and that's it. I do think that Reddit and Twitter are great platforms, or X. But I wouldn't say that it's on daily basis. I'm really more focused on stuff that I have to do for myself, and I don't have as much time for that. And use some retailers like Lululemon, Nike, and Ulta. Yeah, so for those, by coincidence, I think for 2 of the 3, Lululemon and Ulta, I had written some posts there. I think by far I'm most interested in the development of Nike, because Nike is a huge brand and it's struggling now for quite some time. I think it's in the 70s, right? Let me see, what's the share price now? 71. So it has been at 170 at some point. By coincidence, I I shared, I don't know, maybe it was it 2 years ago? I shared I wanted to make a free course for on valuation, and I used Nike as an example. And I remember that, so it was probably somewhere in here. It was like $100 something a share, and I thought it was worth 60. Um, and that was basically the outcome of the valuation. But I went, through the annual reports and all that stuff, just to make it as simple as possible. So I'm not. So based on my opinion, I don't think that this is a bad performance because Nike is doing bad now. I think this part here was just like really, 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 really elevated price that just was not fair. And yeah, I mean, I looked at Lululemon as well. I think they're the ones that have a completely different strategy in the sense that they went for micro influencers. So they wanted to promote their products through yoga instructors and fitness instructors, as opposed to getting Messi and LeBron James and all the big stars. So I think that they had the wisest strategy that was relatively new at that time, and they managed that paid off. I'm the one thing I'm worried about them is product wise, their price points are quite high, and there are a lot of copycats already entering the market, and I'm not sure if they have a competitive advantage that will allow them to keep that position over the next years. I'm not sure. So far, they're doing well, but if the market implies that they are going to grow, it will be tough. It's not an easy market. Retail in general is not an easy market. For example, do you follow newsletters or podcasts related to finance or in general on daily basis favorite shows? I like The Secret CFO. So I think he's also on Twitter. He has The Secret CFO a newsletter. I think that he's doing a really good job. He's unknown, but I think that what he shares is really good. Is thoughtful. It's well written. That's one of the newsletters that I'm subscribed to, that I actually almost always read. But for the rest, I wouldn't say that there's much that I'm subscribed to that I always read or often read. I do like some YouTube content creators like The Plain Bagel and Patrick Boyle. I think he has like some sort of a dry sense of humor, but in general, The Plain Bagel does a good job at breaking down, and also he has some sort of humor. I'm not sure. I'm thinking what else. I think Twitter in general has or X has a lot of valuable insights there. I think that there's a lot of really good, really smart people there that share valuable content. But this is also the danger that social media brings. On one side, of course, you have the opportunity to follow a lot of people, right? The danger is that you get surrounded with people who think exactly like you, and that they just reinforce your opinion. So if you are, and you can see those kind of cults forming. Tesla is one example, right? If you take a look at Twitter, if you analyze Twitter for 2 hours, you can find like, let's say 10 individuals who are bullish on Tesla, and that any information that comes their way would be translated into why that is better for Tesla. So interest rates went down, oh, that's great for Tesla. Interest rates went up, oh, that's great for Tesla. And they'll figure out the rationale. So you have to figure out who to follow. I think that's very important. It can go really bad if you surround yourself with individuals who think like you. I think that's quite dangerous. That you should find people who disagree with you and figure out why, and then it's either either somebody's wrong or you have to agree to disagree, and that's perfectly fine. I do listen to podcasts. To be honest, in the past I used to read and listen to a lot more finance related stuff, like just pure finance. At some point I felt like the more I read and listen, it's not so much that this learning curve. It reached a point where I was just reading stuff that I knew, or I was listening to stuff that I knew, and it didn't feel like the the right content to consume. So now I'm trying to, or the last maybe few years at least, probably even more than that, I'm trying to diversify into the knowledge that I consume. There's a lot of marketing stuff that I understood. There's a lot of a bit of history. There's a bit of biographies a few biographies that I've been reading. And it's interesting that a lot of them actually help when it comes to analyzing a company, because psychology plays a big role in all of these spheres. So there's nothing that I follow on daily basis. There's nothing that I do that's like a routine. And also, having a child, you can't really establish a routine. But there's a few things that I would do when I have time, and one of them is I think I read more than I consume recently, at least than I consume content over the screen. Or normally on Monday I have more time to drive, so that's when I have at least 3-4 hours to listen to podcasts. And I don't know, maybe it will be the Joe Rogan one with Mark Zuckerberg this week. Let's see. I found your channel because that Nike series of videos, and I think you're a guy that I know that has a fund says he's waiting for a PER 8 to 10. I guess it's PE 8 to 10 for Nike. Yeah. I'm not using the ratios. They can be misleading for a short period of time. But yeah, Nike's, and I know was it Bill Ackman? I think Bill Ackman had quite a position there. I can quickly check that. Founders podcast might be interesting as acquired. I listened to, was it 20 VC? 20 VC. I think there's this 20 VC, which is kind of like a venture capital podcast, but they also have a lot of CEOs. I found some of those discussions very interesting. I like, there's called My First Million, I believe. That's the name of the podcast. I think it's also on Spotify and on YouTube. I think that they also have really interesting stories. But like really, it really depends what your goal is. I in the past I used to consume content because I thought that's what I should do. And at some point, it was more targeted content. So it's not I listen to podcast because it would help you, but what kind of knowledge do I want to acquire? And then I need to figure out what is the content to listen to. So it was more important in the last years to go outside of my comfort zone and figure out other stuff. Especially since I wanted to I started my own company, and I had to get more diverse in terms of skills. And to be honest, even having a YouTube channel for fun and to share stuff, that also helped 100%. I think if you want to be better at anything, write. If you don't feel comfortable recording videos, write. If you write something down, you'll read it yourself. You'll have questions and you'll try to figure out how does that sound if somebody else reads it, and you'll rewrite it. And at some point you get a much more refined version of your thoughts, and that will benefit you. And it will benefit you not just personally, but also professionally, right? If most conversations are online, right, happen through email. So if you're able to revise your thoughts and come to a much cleaner version of your thoughts that can be easily communicated, it's clear, that the other person can quickly understand, there are no questions, that's really, really beneficial. And I mean, you'll be surprised how many emails are unclear, and you have to ask a follow-up question. So being able to share your thoughts quickly and in a way that the other person can understand them without question, that's definitely a valuable skill. So, and writing down, that definitely pushes you to do that, because I mean, you have no choice. You have to, if you want to share something that someone else will read, the first thing that you have to do is make sure that it's readable. You have to make sure that they don't have more questions than answers. But I was looking at let me just I was looking at Bill Ackman's portfolio, and yes, it has quite some exposure to. Let's see, has quite some exposure to Nike. I'm not surprised as much. Um, Again, it went down a bit. I'm surprised that Bill Ackman is the one. Normally, he's like, if you take a look at his portfolio, um, there's nothing that's even close to Nike. So he's never been into this kind of sector. He's never been into, or he doesn't. I don't know. Doesn't strike me as the person who would. It's not. It's not a type of company that he normally adds up to. But if you take a look at the value, the value, right? This is obviously as of 30th September. That's still quite a big position. It's, one of the top 5, 6, 7 for him now, depending on the share price. And yeah, it's quite a big bet. Let's see how it ends up. Let's see how it ends. What is the biggest challenge for you starting your own company? I've been fortunate to not have any big challenge yet. I've been fortunate that I can manage my time enough and have a balance and have enough time to develop myself and further invest into my development, again, for all of the different skills that I'd like to acquire in the future. So I'm not working Monday to Friday. I'm not working, I don't have a time schedule. Instead, I probably work 7 days a week with a lot less. It depends on the day. Sometimes it's 8 hours, sometimes it's 2 hours a day. So I don't, as such, I haven't had a big challenge from any aspect, but that's likely because I've had enough experience so that when I have to get a client starting out, I didn't have a challenge. It was not that difficult. I could prove that I could do the job, and it was relatively smooth. The only thing is, I'm not sure if it would be labeled as a challenge, but I haven't had intentions to scale up. I haven't had intention to make it like a big deal with tens of employees. So I most of the time work with freelancers, depending on the types of support I need. So I'm working with a few that support me with various tasks. So it's not a one-man company as such, but it's also not a 10-man company or a multiple of tens of employees. And maybe you could argue that it's a challenge that I haven't scaled it yet, but I would say it's more of a conscious decision not to scale it because I know that it comes with more responsibilities, and I'm not somebody who's motivated by earning a lot more. I'm motivated more just by adding value and just enjoying life, and I would not sacrifice that. I would prefer to have enough freedom to spend time with my family and still again have enough work to feel useful, to develop myself, and so I'll keep it but I have not had any challenge. I think I need to figure out, maybe I need to have a challenge myself. I need to make a challenge for myself. I think learning about different companies has been probably the most valuable or the best return of my time. So I was working with diverse clients. I had no choice but to learn about these businesses, and there's so much to learn. So sometimes it's a challenge to understand how some certain industries work, but after that, once that is over, then it's just really rewarding because I can use that knowledge working with any other client, and that's just amazing. That's just amazing, and it is incredible to see how much in common certain companies have or certain niches or industries have, and you can use the knowledge from one example, from one case study to another. And I'm sure if there's any topic that pops up when it comes to business, then I have an example that I face at some point that I can elaborate on, so that if somebody even has no accounting knowledge or finance knowledge, I can still figure out how to communicate that and to break it down so that it's understandable. I think that is a really valuable skill that it takes time to develop. And I'll still get. I'm sure I'll still improve in that sense. One thing that I don't think has been talked about a lot is, like, for example, I'm not sure if you knew, but for example, everybody knows Disney, right? Walt Disney has been the genius behind the company. He's been someone who's been really creative, and one of the characters that he developed was Mickey Mouse, right? Mickey Mouse was one of the first characters that he developed. And here's a funny story. Back probably in his before he was 30, he was already at a relatively high position at a Hollywood studio. So he already has kind of made it from a finance point of view. He was earning enough money, but the company went under, or something happened, and eventually he was without a job. But also he didn't have any intellectual property because all the characters that have been developed didn't belong to him. So he had this idea. I have this idea of a mouse, and he has red vest or whatever, red pants and white vest. I'm not sure how Mickey Mouse looks like in detail, but he went home to his wife and he said, I have this character, and his name is Mortimer Mouse. And he explained in detail his vision. And his wife said, Mortimer, you should choose a more friendly name. You can't go with Mortimer Mouse. It doesn't sound very user-friendly. So she suggested, how about Mickey? And that tiny suggestion, I think, had a significant impact on the success of Mickey Mouse. And sometimes these tiny stories add up, and then if somebody suggests a name, these are the type of stories that come to mind. And it's like, oh, well, how would that be perceived from someone else? Is there any alternative that would sound better, that would be more applicable, more appropriate? And I think that's one way to take these lessons from the past and to figure out how to incorporate them in the present. In DCF, could you explain again how you calculate the reinvestment rate? Yeah, let me open again the almighty Excel. So what is the reinvestment rate in this case? So let's assume that you have a company that it has property, plant, and equipment, which is its inventory or stores or whatever it has of 100. It has, or let's keep inventory of 50. Receivables of 10, and it has, let's say all the liabilities are minus 50, and maybe it has, I don't know, let's assume it has also some cash of 40. So its equity is 150, right? So if you take everything together, it's 0, right? So this is the balance sheet. Now this is what the company has invested in, right? And it earns revenue of 500, or maybe let's keep it simple, 200. I'll use dollars, right? So what has the company invested? Well, the cash is not really capital, right? It can just distribute it out and pay out its dividends, right? Liabilities, it depends. Let's assume that it's a loan, right? Let's assume it's a loan. So actually, the assets that are in use is this part, right? This is what is being in use. Maybe I'll use a bit. So they, with assets of 160, they are bringing in revenue of 200. So that is the capital of 160 to bring revenue of 200. So there's a ratio between the capital invested and the revenue. Now let's assume that they have a payable, like trade payable of minus 10. So, right? Now this is also part of the working capital because that's just, everything that is being required to bring the 200. So let's keep it like this. So they have total capital invested of 150. So this is the capital invested 150, right? Those are the green cells. And they're bringing revenue. So now if your question is, well, this revenue is going to grow 3 times in the future. It will grow to 600. How can it grow to 600? Well, the capital invested has to grow by 3 times as well, right? Otherwise, well, how would it grow, right? And this is especially true for companies that are larger in size. For smaller companies, it's a different question, but basically they have to have more property, plant, and equipment, unless for a smaller company they have already excess capacity they can use. They have to have more inventory so that the new revenue can be sustained. They'll have likely more receivables and more payables. So this ratio between the revenue and the capital invested, basically what we're trying to do is establish the ratio between the two, so that if you're assuming certain growth in revenue, then we figure out how much needs to be reinvested into the business as capital to support that revenue growth. And that's, in a nutshell, that's it. So you can't expect that the revenue grows 300 but without any investment. It's just not reasonable. So this is kind of the way that the easiest way to explain the capital to sales ratio. So we start with how does it look like now, and assuming that is the case, this is how it would look like in the future. But that doesn't mean that you should not question this. In a sense, let's assume this is Tesla, and in the PP they have capacity for 6 million cars a year. Well, if they're not there yet, they don't have to invest as much capital. But if this is a company where there is no excess there's no excess capacity, then obviously they'll have to invest a lot more. So just keep that in mind, so that when you look at the sales to capital, you can subjectively change it if you have reason for that. I hope that this makes it clear. So you have the capital, the revenue, or sales ratio. What's your biggest mistake on a particular investing, and what did you learn? I think I would point out to 2 of those. One would be, I would say, GoPro. Luckily, it was a really tiny position. So, and I'll open both. So let me see. So the first one would be, I would say, with GoPro. So GoPro was, and I mean, there's still a chance that it's being turned around, but I didn't hold it all the way. I think I probably had a loss of, I think it was somewhere, let me see, October. I think I had a loss of about 60%, maybe something like this, and I just didn't see any improvements as I thought that is possible. So this is one that I don't think that the company used the brand, or the management didn't use the brand enough. They switched to a subscription model that just didn't work as much as expected. So this is one that where it was difficult also to judge, because the model they offered was slightly different. Instead of selling the cameras at a profit, they were selling the cameras at almost at break-even point and charging subscriptions for software, and that was their margin. And that turned out not to be the best approach. So that was one thing, and that's again a lesson to learn, that sometimes the question is, how relevant is this software, and can it be? Are there other alternatives that people would use? And in this case, it turned out that is the case. So, that was the flaw in the rationale. And the other one is HelloFresh. So I bought it. Let me think. The first time was probably somewhere again in October. I was buying. I think up until here, I sold. I was buying in the 20s. I sold a position here at the peak, and as it was going down, I kept buying more. So now it's a positive position. I'm profitable on it, but this is one that surprised me the most, especially if you zoom out, or you zoom in a bit even here. There was one drop here of 40%. That was like one day, and I remember because I got I'm not sure how I. Was it a notification, or did I check my portfolio? At some point, I was like, that's weird. That's quite a big jump. And I think one of the reasons was they completely got rid of the guidance. So they had a certain guidance. I think it was 10 billion by 2020. 6 in sales, and then they just completely got rid of it because it was not achievable anymore. But basically, the market punished them. But since 686, it went down to, what was it, 4.5, and since then it's up to 100%. So I was lucky to buy more here because I didn't think that this is a company that would go bankrupt, and it's generating cash flow, and they invested a lot in the infrastructure. And I still think it's undervalued. That's why I'm still holding it. But at some point I was probably down like 60%, and from the 60% I'm now up a few percent, which is again not great. But that's why I'm labeling it as a mistake, because one thing that I overestimated was probably the impact of the customer stickiness from the COVID-19 period. Probably they were it was more appealing back then. They're still doing good, but they have been doing slightly worse than I expected. What's your biggest mistake on a particular investing? Yeah, that was the one. And China looks pretty cheap. Would appreciate your views on anything interesting in the US that you have significant conviction on? I like Upwork. I've said that before. I think that's one of the best performing companies that I have, like 60-70% up. I think that's one that can benefit from the shift of the workforce to the younger generation. But the management is not great. I'm a fan of the company and the potential it has, but I don't see the management executing that good. And the second one is Match. I think Match is one that will only do better over time. I don't see again it being disrupted. There has been always this fear that Meta will disrupt it, but to be honest, those fears have been around for way too long, and nothing has been done. And it's quite clear that Zuckerberg focuses on a lot of other stuff, but you never know. Yeah, Factor was a big driver. Yeah, I mean they've diversified a lot towards more ready-to-eat meals, and that is paying off. So, but I mean if you take a look behind the curtain, they have really cool infrastructure, a lot of automation, the way that the operations are being set up. So, and I also, the CEO had also a few podcast appearances that I've listened to, and I thought that he's sounds like a smart person, and there's a lot of work that he still needs to do. And I remember you at some point you could hear in his voice that he was disappointed by the market reaction, because at one point in some interview he was asked like, the share price is down, so what are your thoughts on that? And I know his response was like, yeah, this makes no sense. This is not how much we're worth as a company. The market doesn't appreciate what we do. And his response was, which I think was the smartest thing to do, he did so much buyback. Every excess cash that was available was used for buybacks. And yeah, I think that was really, really smart from him. But again, it's a competitive industry, and there's a lot of work they need to do. But yeah, the margin will only go up if they have more customers, because when you deliver anything, the more you can fit it in a van to deliver to one neighborhood, the better your margins are. So if you have one customer, largest holding, average price 7.5. Quite good. UiPath, I have not looked at it in detail. I know that they had some automation, some sort of a software that would record the activities that one does on the computer, and then just mimic what one person does. But I have not looked into it in significant details yet. But I think I'll be wrapping up. The stream. It's been like 2 hours now. Thank you for joining. I'll try to figure out if I can make this a weekly call or maybe bi-weekly. it's always nice to connect with others, and I appreciate all the discussions. Of course, it's the first one that I've done, so I'll try to figure out how to make it more interactive, how to have more polls, because I'm quite sure that there's so many. There's a Q&A, there's a poll that I can add, but I also try to figure out more interesting topics, not necessarily related to last week or the week or a few weeks before, but also try to figure out how to bring real examples of companies that might help you as the viewer and just add value to your knowledge, or make sure that you understand some parts of accounting or some parts of business a bit better. So I have homework to do there for sure. I appreciate you joining. I think I'll call it a day or a night. Maybe that's more accurate, given that it's just a little bit past midnight now. And we'll keep in touch. Any questions, any comments, any suggestions that you have, feel free to let me know, and I'll take them into account for the next stream. Let me figure out. I need to. Enjoy the evening. Enjoy the rest of the weekend, and see you soon. Take care.